This is the Wealth Ability Show with Tom Wheelwright. Way more money, way less taxes.
President Biden, in his recent State of the Union address, made it clear that taxes are on the ballot this year. And the question is, how will that impact you? Both sides say something different about how it will impact you, who it will impact. It's a really interesting topic that I think affects all Americans, not just some Americans. It's going to affect everybody. And we're so fortunate today to have Ken Kies, who is, if I could pick somebody to talk about this topic, it would be Ken, because of his extensive background in tax policy, his current work. And Ken, thank you so much for joining us. And if you would, give us not just what you're doing right now, but a little of your background, because it is one of the most impressive backgrounds in the tax field I've ever known.
Well, thanks, Tom, and nice to be on your show. So, some people would say I've been around Washington as long as Thomas Jefferson, but that's an exaggeration. Okay, but I did go to work on the Ways and Means Committee staff. The Ways and Means Committee is the committee of the House of Representatives that has jurisdiction over tax legislation. I worked there from 81 to 87, so I was there not only for Reagan's tax cut in 81, which was a huge bill, but also the 86 Tax Reform Act, which many people are still talking about. I left the Hill and went back to my previous law firm, which was Baker and Hostetler. I was the firm-wide chair of the tax practice. I was in Washington, D.C. In 94, Republicans took control of the House and Senate for the first time in 40 years. I went back to the Hill, and I was the chief of staff of the Joint Committee on Taxation. And the Joint Committee on Taxation of the Congress basically writes all the technical language for both the House and the Senate. They analyze tax treaties. They do all revenue estimating, which is a very big deal in today's world, particularly given our deficit numbers, which are just breathtaking. So I was there from 95 to 98. And a lot of people, Tom, I'm not sure they realized it at the time, and I surely don't realize it now. The 97 tax bill, which was a $275 billion tax cut over 10 years, which back then was real money, was the first net tax cut that had occurred since 1981. All the other tax bills between 81 and 97 were either tax increases, as in the case of Clinton's 93 tax bill, George Herbert Walker Bush's 90 tax increase, or the 86 bill, which was revenue neutral. So when I left the Joint Committee in 98, I went to be head of PwC's Washington National Tax Practice and left PwC in 2002 and brought with me the Federal Policy Group, which was where I've worked ever since. And in my current job, I do a variety of things in the tax space. I handle controversies with the IRS. I've been an expert witness in federal district court tax cases, tax court tax cases. I represent a number of clients on Capitol Hill who are dealing with legislative matters, which you've already alluded to. And I also represent taxpayers who are trying to influence the outcome of the regulatory process at the IRS, which is a huge part of how tax policy gets made. A lot of tax legislation leaves unanswered a lot of important details, and those get fleshed out through the regulatory process. Unfortunately, they also sometimes get fleshed out by resorting to the courts, and that's really the worst way to make tax law, but it unfortunately happens from time to time. So that's probably more than you wanted to know about what I do.
I tell you that, Ken, that's awesome, an amazing resume. Thank you so much for joining us. We could spend a whole hour just on the IRS creating law and Congress's abdication of its duties by letting or directing the IRS to make the law. So the Joint Committee on Taxation should be writing the law, but a lot of times it's National IRS who's actually writing the law. And we learned that just recently, where the EPA issued regulations that would make it practically impossible to buy a gasoline car by 2032. So that's regulatory. That's not Congress that's doing that. That is regulatory, and that is a little challenging for some of us that there's that much power in the regulatory authority.
So that absolutely right, Tom. But let me just flag for all your listeners that there's a case in front of the Supreme Court right now that could materially impact the ability of the executive branch to write extensive rules about legislation Congress has passed. And it all goes back to a Supreme Court case that's decades old. It was a Chevron case, and it's called the Chevron Doctrine. And what the Chevron Doctrine says that if the executive branch is writing regulations, there's this two-step analysis as to whether the courts and taxpayers and other people affected have to follow those regulations. So the two-step analysis is step one, is there an ambiguity in the statute? Well, show me any statute that doesn't have an ambiguity. So that's step one. Is there an ambiguity? Step two is, was the regulatory action taken reasonable? A pretty low bar. And if those two steps are met, then the Chevron Doctrine says that the courts and affected citizens have to follow the regulatory guidance. The case before the Supreme Court threatens to throw out the Chevron Doctrine and say the executive branch doesn't have that kind of regulatory authority. It's only if the statute explicitly gives the executive branch the authority can they write regs. This could be a game changer, and not just in the tax world, although it's been relevant in the tax world, but the Chevron Doctrine applies across the board. So there's another case that people have talked about, the so-called Moore case, which I'm happy to talk about at some point, which was argued December 5th. But the Chevron Doctrine case, it could almost be as bigger than the Moore case.
Yeah, I think you're right. We tend to refer to the two different regulations as legislative and administrative, right? So legislative means that the Congress actually directed the IRS to write regulations, and it says so right in the law. And others, the IRS is just deciding to write regulations because they find some ambiguity, they find a need to write the regulations. And if I'm understanding this case, if we overturn Chevron, would make it really hard to write those administrative regulations, and it would only be the legislative regulations that were written.
Yeah, and again, I can't emphasize how big a deal this could be. And for those of us that just kind of run around in the tax world, that's our way of thinking about this, but it goes way beyond the tax world, the EPA, the Labor Department, you name it. And we're likely to get that decision before the Supreme Court adjourns for its summer recess, which is typically the end of June. So stay tuned on that one.
Yeah, that's actually, it's interesting. We're talking about that during an election year. We're going to talk about the policy. We'll talk about Biden's Green Book. We'll talk about what's on the table for this election. But remember that a lot of tax law is decided in the courts. And in this case, this would be a major change. And I know that for those of you who don't read tax law like Ken and I do all the time, it still has an impact, because what it means is that the IRS can only make law when they're told to make law. And that actually is a really big issue, because the IRS currently has a tendency to make law just even without regulation. Right now, they are making law. They're making law by how they audit. They're making law by how what kind of force they put behind something that they disagree with. And the law may be very clear that is available, and it's a provision that is a beneficial tax provision to certain taxpayers. And the IRS says, well, we don't like it. I actually listened to the IRS chief counsel a couple of years ago with a straight face say, if it sounds too good to be true, it's illegal. I'm going, there's a lot in the tax law that sounds too good to be true. It's in the tax law, and it's not a loophole. It's there on purpose. So, even something like I can donate my Bitcoin that went from $4,000 when I bought it to $70,000. I can donate that to a charity, not pay tax on the capital gains, and get a deduction for the $70,000. Well, that sounds too good to be true, but even the IRS doesn't fight that one. So this is a very big change. So something to watch out. And when we get closer to that decision, or we get that decision, we'd love to have you back and have a very specific conversation on that. Let's turn our focus now to the major tax policies of the state, because President Biden was very clear. Tax is, I think, you can tell me if I'm wrong, but this is the first time in my memory that a presidential candidate has run on the idea of tax increase. Not we're going to reduce taxes, not we're going to make it more fair, but rather we're going to run it on an increase. So I want to start with just really broadly, what are some of the major tax policies that are on the table in this year's election?
Okay, so just to correct your point about you've never heard of candidate run on tax increases. They have, but they lost. Okay. So but I understand your point,
Good
which
point.
is it's pretty unusual for somebody to think a winning agenda is I want to raise trillions of taxes. But when President Biden gave his State of the Union address on March 11, and just to be clear, he had to stay up kind of late that night. But he came out swinging and this is a theme, and I don't mean this to sound partisan, but it is a theme of his administration.
Sure.
That the wealthy don't pay enough. And so he laid out in his State of the Union address some broad description of tax increases, wanting to raise the corporate rate from the current level, which is 21% to 28%, wanting to increase the top rate on individual taxpayers up to first 39.6. And it drives me crazy because the tax press frequently will say, well, if the Biden proposal is adopted, the top income tax rate will be 39.6 instead of the current level of 37. But they always leave out the Medicare tax, which applies to all income. And just to be clear, calling it a Medicare tax is a gross misrepresentation. The money for the so-called 3.8% Medicare tax does not go into the Medicare trust fund. It goes into the general fund. It was one of the great marketing gimmicks to say it was a Medicare tax and make old people feel like, well, at least it's helped me pay my Medicare. Well, sorry to tell you, it doesn't. So the Biden proposal would raise the 3.8 to 5.
Right.
So when you combine 39.6 plus 5%, that means the top marginal rate for federal taxes would be 44.4. And for those of your listeners who have the ill-advised decision to live in California, where the income tax rate is well above 10%, that means we're talking about marginal tax rates well over 50%. But for those of you in California that are feeling sorry for yourselves, let me just note that astonishingly, New York went by you in terms of the highest state and local tax rate. But it still means both California and New York, Illinois up there would have marginal tax rates well above 50%. So that was in his State of the Union address. And he talked about a bunch of other things, just to be clear. But what happens as soon as the State of the Union address is given is, and I said the State of the Union address was March 11. I believe it was actually March 7. The budget was released March 11. And on the day that the budget is released by the Office of Management and Budget, called OMB, the Treasury Department, and this is true of Republican and Democrat Treasury Departments, release what's referred to as the Green Book. Now, the reason it's called the Green Book is they used to publish it in hard form. Of course, nobody has anything in paper form anymore, but when they did, it had a green cover.
Right.
But they released the Green Book, which is a much more detailed description of the administration's tax proposals beyond what the president talked about in the State of the Union and beyond what's in the OMB budget documents. And when you look at that document, you learn a lot more about what the administration is proposing. For example, they would propose basically taxing all capital gain income at ordinary income tax rates. Now, under current law, the rate on capital gain generally is 23.8. It's 20% plus that 3.8% so-called Medicare tax. But under the Biden proposal, it would increase the capital gain rate to the ordinary income rate, which I've said is 44.4. It would increase the corporate rate from 21 to 28. That raises over 10 years, 1.4 trillion roughly. And these numbers are so big that it's hard to get your head around them. And I got some really bad news for you, Tom. On Capitol Hill, a lot of members of Congress, I'm not making this up, don't really know the difference between $1 billion and $1 trillion. And I'm convinced if I went to Capitol Hill, went up to every member of Congress and put 2 sheets of blank paper in front of them and asked them to write out what is $1 billion on one and what is $1 trillion on the other, I'm not sure half would get it right. But let me just say, one tax proposal that raises 1.4 trillion over 10 years is a really big tax increase. The proposal would also, for businesses, essentially deny as a business expense any compensation paid to any worker that's over $1 million. Now, there's a current law provisions called 162M, which applies $1 million cap, but it's generally the top 5 executives. It's sometimes a little broader. That provision would raise hundreds of billions. And here's the bad thing about that proposal. It takes us further away from a net income tax. Generally speaking, I think what the Congress had in mind when they passed the 16th Amendment, which made it legal to have a net income tax in America, was that both businesses and individuals, we'd be taxing them on their net income. So their gross income less the expenses necessary to generate that income. So whether they were an incorporated business, unincorporated, whatever. And Congress over the years has moved away from that. The limit on deducting $1 million compensation is just one example. But that's also in there. And there's probably 40, 50 tax proposals, some of them smaller items, but the net effect would be multi-trillion-dollar tax increases.
Yeah, so let's talk about that. So what's the swing? So, okay, so that's the side of, this is what Biden's proposed, and he's very specific. So if you want to know what you would get with a Biden administration that, of course, had both houses of Congress, but if you want to know what you get, you can, that Green Book, and I'm going to do a separate video that will actually walk through the Green Book in great detail. But it's a blueprint, right? It's a blueprint for what they want to do. Not too dissimilar from Build Back Better. That was originally proposed by Biden and Sanders. But now we also have the effect of the 2017 Act, which starts to sunset. And can you kind of walk us through that sunset and how that would work? Because what I want to do is I want to compare and contrast the two sides. On one side, we know it's about a $5 trillion tax increase. So we're pretty clear on that. Biden's put it out. It's been scored. It's right in that $5 trillion range. So then we also have this issue that even if they just let it lapse, you've got a tax increase because the 2017 law, because of this 10-year budget rule, is going to start lapsing. And just walk us through that, Ken.
Yeah. So specifically, the 2017 Act, which included maybe the most significant substantive tax changes since the 86 Tax Reform Act. So a fairly major piece of legislation. Among other things, it reduced the corporate rate to 21%. It reduced the individual rate down to the 37 plus the 3.8. It also included the $10,000 cap on deductibility of state and local taxes, which a number of people, particularly in the blue states, don't care for. But it also included, believe it or not, one of the biggest tax benefits was a provision called Section 199 Cap A, which is a deduction. It's a 20% deduction for businesses that are not C Corps, which is generally large corporations. That provision was included very specifically to make sure that when we reduced the C corporate rate down to 21%, we weren't going to be taxing unincorporated businesses at a much higher rate than C Corps. And, a number of senators and congressmen were saying, if we don't do this, I'm going to have to go home to my constituents and explain, and this is always the way they talk about it, explain why Exxon has a lower tax rate than the guy that owns the local drugstore. And that was a real concern. So 199 Cap A is a 20% deduction for unincorporated businesses.
And that's a big deal, Ken, for a lot of our listeners. A lot of our listeners are small business, they're entrepreneurs, and that 199A deduction, the qualified small business deduction, that is serious. I mean, it takes the top rate down to about 29.6% from the 37%, and that is huge.
Yes,
that was a major tax provision in favor of small business in 2017.
absolutely. And I'm a big believer, and maybe it's because when I was head of the Joint Committee, we did all the revenue estimating. If you really want to figure out what's a big deal in a tax bill and what isn't, go straight to the revenue table and look at what is the 10-year effect. Well, 199 Cap A, I think after the reduction in the corporate rate, was the single largest revenue loser in the 2017 Act. I believe it was over $600 billion over 10 years. It expires at the end of 2025. Now, the corporate rate reduction does not expire. And the reason is that there is a budget rule that says if you're passing a tax bill and you're using what's referred to as reconciliation protection, and the significance of that is that you don't have to, you're not subject to a filibuster in the Senate. So you can pass the bill with only 60 votes. You're only under reconciliation protection if you've passed a budget resolution in both houses. But if you're under those rules, you can't have a provision that loses revenue outside the 10-year window. And the 10-year window from the 2017 Act ends at the end of 2025. You can't have a provision that loses revenue unless it is paid for. Well, it just so happens the 2017 Act had other provisions like the corporate rate that were permanent law that raised revenue. So those provisions actually raised enough to offset the corporate rate. And that's why the corporate rate was permanent law. The individual provisions that we've already talked about, there was not enough revenue elsewhere in the bill to cover the costs of those provisions. And that's why they all sunset at the end of 2025.
So which are do all the individual provisions sunset? For example, does the state and local tax deduction, does that sunset at the end of 2025?
Great question, because that is kind of has a quirk. The limitation of only being able to deduct $10,000 a year, that expires at the end of 2025, which means if Congress does not act in 2025, people will be able to go back to deducting all of their state and local taxes. That makes it very likely when Congress does actually craft a piece of legislation to address the 2017 expiring provisions, that they probably are going to extend the limitation on deductibility of state and local taxes, at least in some form or another, because it will raise revenue that can help offset the cost of doing the other things that Congress is going to want to do. Now, what Congress is actually going to want to do about the expiring provisions and when they're going to do it is yet to be determined and will be dramatically impacted by the outcome of the upcoming November elections. And at some point, I'm happy to talk about the two most likely scenarios and how that's going to impact what may happen.
Let's do it right now. Let's go ahead and get into those two most likely scenarios, depending on who's in office.
Okay, so the two most likely scenarios, and this is based on some pretty good analysis of the polling that's going on, et cetera. Scenario number one is Biden gets reelected. If he gets reelected, it's very likely that control of the House will shift from Republican hands to Democrat hands. But it's also likely, and this is sort of a weird lineup, that control of the Senate will shift from Democrat hands to Republican hands. So come next January, under scenario one, Democrat in the White House, Biden, Democrats in control of the House, Republicans in control of the Senate. Okay, under that scenario, it's going to be quite a negotiation that will take many months and may well stretch beyond the end of 2025. Many believe that Congress must address all these provisions expiring at the end of 2025. You need look no further than the pending tax bill that is passed the House 370 to 50 or something, that's been stuck in the Senate now for a couple months, which deals with provisions that started expiring back in 2021. A number expired in 2022, and some expired in 2023. And that piece of legislation is not even done yet and may not get done this year at all. So when you step back and look at the situation we're going to be facing in 2025, a bunch of provisions will be expiring. But you have to ask yourself the question, when does Congress really need to figure out what to do about this? Well, point number one is when all those provisions expire in 2025, the first tax year they're going to affect is 2026. So the question is, when will taxpayers file their 2026 tax returns? Generally, individuals will be January, February, March, April of 2027. So under scenario one, it's not inconceivable that, yes, Congress would get to work on trying to negotiate a deal on what to do about all those expiring provisions, but not finish its work in 2025. That's a very plausible scenario. Now, scenario two, which is the other most likely outcome of the November elections, is Biden doesn't get reelected, Trump does. If Trump wins election, that means he probably, and the Republicans are probably able to retain control of the House. Right now, there's a guy named Nathan Gonzalez who does polling on all the House races, and he puts out his analysis every week. And right now, he's saying that of the 435 seats in the House, Republicans are either safe or it leans in their direction in like 216 seats. Well, that's just too short of keeping control. He has Democrats at about 209. If Trump wins, that means the toss-up races, enough of them probably break for Republicans, and Republicans retain control of the House. The reason I mentioned under scenario one, Republicans losing the House, is if Biden's winning, it means his voters have turned out, and that means they're going to pick up seats. But scenario two, Trump wins, Republicans retain control of the House, and Republicans would almost certainly, under those circumstances, take control of the Senate. All right. So in other words, Republicans would control White House, House, and Senate. Under those circumstances, we could easily see a tax bill addressing the 2017 expiring provisions get done in 2025. And indeed, there is a long pattern. It hasn't always been followed, but I can point you to multiple times that it has. When a new president gets elected, particularly if his party controls the House and Senate, in that first year in office, there is a window of opportunity to do big things, but it tends to close about the time of the August recess. Now, in the case of last time Trump was president, he got his 2017 bill done in December. So it went on a little longer, but I could point you to Reagan, to George W., to Clinton, the new presidents who got their big tax bills on in that first 8 months in office. And just as a footnote here, if Trump gets elected, even though he will have been president once, he will still functionally be like a new president because he's obviously been out of office. And so under scenario 2 that I've laid out, we might actually get an answer to what's going to happen to all those provisions that expire at the end of 2025 in 2025. Clearly, a better outcome, and that is that we actually know what the law is before January 1, 2026 rolls around. But that's how I see the two most likely scenarios in terms of outcome of the November elections affecting that tax legislative picture.
Do you have a feel for what the Republicans would actually do? Do you think they would just extend them and say, we're good? Or do you think that there are some major changes that they would make?
So we already know a little bit about that. It's likely, again, apologies to those California and New York listeners, it's likely they would extend pretty much the SALT provision to raise revenue. It would raise hundreds of billions. It's likely that they would move to repeal many, if not most, of the so-called green energy provisions that were Biden succeeded in getting enacted in August of 2022 in the, I hate to even say these words because it makes me crazy, but the so-called Inflation Reduction Act, which did not have any impact whatsoever. I mean, if the Federal Trade Commission had jurisdiction over Congress mislabeling pieces of legislation, the people that called that the Inflation Reduction Act would all be in prison right now. Okay. but in any event, I'm talking about all those energy provisions.
Right.
And here's kind of a weird thing, Tom, about repealing those and using them as a to pay for the cost of extending the expiring 2017 Act provisions. When those provisions were enacted in August of 2022, my old office and staff, the Joint Committee on Taxation, based, in fairness to them, on the best information they had available to them at the time, roughly estimated all those green energy provisions, EV credits for cars, hydrogen, all that stuff, at losing about $300 to $350 billion over 10 years. Well, since those provisions were enacted, as the IRS has moved to implement those provisions, let me just be kind to the IRS and say they've been quite generous in the way they've interpreted them. Unlike the things you were referring to earlier, Tom, where the IRS is not generous, in the case of the green energy provisions, the IRS essentially couldn't be too nice. Well, as a result, and the Joint Committee on Taxation has not put out a number on this, but it is widely believed that if those very same provisions were put into a bill in 2025 with a proposal to repeal them, that it would raise perhaps 500 billion, 600 billion, certainly more than those provisions were scored at losing in August of 2022. So that's another piece of what a Republican bill might look like. Another piece, which is not necessarily a tax provision, but which I know that the Biden campaign and the Trump campaign and Trump himself have in mind, is a significant tariff on Chinese imports, in particular Chinese cars.
Let's hold off on that for a second because I want to get
Okay.
to tariffs in a little bit. I want to come back to one of the things that Biden has focused on, and you mentioned it earlier, is tax the rich. The rich don't pay enough. In fact, they would even say the rich don't pay their fair share, which is a curious misnomer because the rich pay most of the taxes. However, here's my question, and this is where I think talk about truth in advertising. For example, Biden's proposed calls it a billionaire's tax that applies to anyone making over 100 million. So I'm sorry, but clearly President Biden doesn't know that there's another zero to get to a billion. 100 million is not a billion; it's 100 millions. And so that's I'm going. But my question is not is it 100 million or a billion? The question is, why would an average person who's making $200,000 to $300,000 a year, because President Biden says we are not going to tax anybody that makes less than $400,000 a year. We're not going to increase your taxes. You are safe. We are taxing only those horrible rich people that make over $400,000 a year. Why would those people need to be concerned about these bills that are, according to the rhetoric, is only taxing the rich that is not them?
Here's why. First, let's just talk briefly about what that provision that you referred to does. It would impose what is purports to be a 25% minimum tax on people over that 100 million / billion level. And at first you might say, well, geez, 25%, that's not too bad. I mean, people making 400,000 a year are probably at a marginal rate of 25%. But then when you look at the detail, there's a very significant difference in the way that minimum tax would tax a wealthy person versus the way the income tax applies to everybody else. And it's this: it would include in income unrealized gains on assets that are owned.
So explain that. Explain what unrealized gains are, just so everybody understands.
Yeah. No, very important. So I buy an asset for $100. I hold it for 5 years. It goes up in value to $1,000. Now, I'm sure almost everybody out there listening has had an experience where they bought an asset, it went up in value, they felt really great, and before they could sell it, it went down in value because things do go up and down. Well, with the billionaires tax, so-called, in the Biden proposals, is it would every year it would require wealthy people to look at the current value of their assets, and if they've gone up from the year before, tax whatever that gain is, even though it hasn't been realized. So in other words, it would be taxing people on income that they haven't yet received and might never receive because the value of the asset might go back down before they can sell it. So it's a really big deal. Canada tried to impose a tax on unrealized gain years ago, and it was such a colossal disaster and failure that they repealed it. The confusion about, well, for one thing, just think about this. If you're in that wealthy category, you would have to value all of your assets at the end of every year. Now, if you happen to be in the appraisal business, you would think you just died and gone to heaven, because people would have to go out and get appraisers to assess what's the value of their assets. Oh, that's just the beginning of the fun, because the IRS would no doubt say that, Tom, you hired an appraiser who just happens to be your brother-in-law, and we have a little suspicion that he might not have been completely straight when he valued your assets at those low numbers. So we're going to contest that. And 5-10 years later, you will resolve your disagreement with the IRS on that particular tax year, because they'll be on to the next tax year where you didn't hire your brother-in-law, but you hired your sister-in-law. And turned out the IRS doesn't think much more of her than they thought of your brother-in-law, and on and on and on. So taxing unrealized gains is something that the U.S. income tax system basically, for the most part, has never done.
Right. And of course, France tried the same thing, right? And they had people leaving They were running away.
In France, they were all headed to Monte Carlo.
Yep.
Or to, well, same thing happened in Sweden, by the way. All the CEOs of all the I was at a dinner with a bunch of members of Congress about 20 years ago, and there were all the CEOs of Electrolux and other major Swedish companies. And I started talking to them, and I said, well, where do you live in Sweden? And they go, well, we don't actually live in Sweden. We live in Geneva, Switzerland. And we fly here 2 days a week. And the reason we're in Geneva is so we don't have to pay the Swedish income tax because it's so high. Well, God bless Sweden. They finally came to their senses and realized all our wealthy people are living outside the country. They lowered their income tax rates down. And basically the people came back to Sweden. And Tom, you mentioned France. It's kind of scary when France has figured out what the tax law should be, and we're headed in the other direction.
Exactly.
Okay, that is just not a good situation.
There is just not something not right with that. With that scenario. But one of my questions here is drift. If you look at 16th Amendment, you look at the original federal income tax. In today's dollars, I think you had to make like $7 million in order to be taxed at all. And those rates were like 1, 2, 3, 4, 5%. They were tiny, tiny rates. Explain what typically happens on that drift when you start. We're gonna sell it by you're not going to pay the tax, but in the end, it appears every time that the average person ends up paying the tax.
Okay, so really good point. And there's a long history you can point to of this phenomenon that anybody who's sitting out there going, well, I don't have to worry about that 25% minimum tax because I'm not ever going to be subject to it. Here's the basic problem. Believe it or not, we just don't have enough rich people in the United States. If we had more rich people, we could just take all their assets and we wouldn't have to worry about a drift problem. But because we don't, and at least so far, Congress seems to have this insatiable appetite to spend money, it is inevitable that once a provision like the one we're discussing gets enacted, the first thing you will hear within a year or less is, if we lowered those thresholds where that applies to X, we could raise another couple $100 billion, and boy, we could do a lot of great stuff with that. And all you have to do, Tom, is look back to the point you made at the beginning of our discussing this topic. Go back to the original income tax, which was enacted in 1913, I think, or roundabout there, and look at what were the marginal rates and who was subject to them. And it was the teeniest amount of people. It's not that the rich paid most of that tax. The rich paid all of that tax. Okay. And a middle income, upper middle income, none of them were subject to it. And you flash that, and then when you come forward, you see what happened up until when Reagan became president. The top marginal rate went from this 1 or 2% number in the original income tax to where it was up over 80%. Okay. Now the 91 tax reform bill brought, it was 70%. That was the top rate on unearned income. Reagan, the 81 Act brought down the 70% so it could never be higher than 50%, brought down ordinary income rates. And then the 86 Act brought the ordinary income rate to 28%. Okay. Now, there's another example of the drift issue you talked about. At the end of the 86, when 86 was enacted, beginning January 1, 87, the top individual rate was 28%. By the time of the 93 tax bill, the first Clinton tax bill, it had popped back up to like 39%.
Well, on top of that, there were two rates, right? In the 86 Act, there was 28 and 15. So the average person was paying a 15% tax rate. And you just were talking about, well, you make $300,000, you're in a 22% tax rate. So even if you're married, you're in a 22% tax rate. So you're already more than what that tax rate was. I mean, even with the decreases from 2017. So it never has gotten back to those 1986 rates.
Yeah, just to cap off the basic point you're making, the presence of drift That is rates going up, exemption levels going down within the income tax is well documented by past history. So anybody that doesn't believe it won't happen again, God bless you. Because I've got a bunch of land in Florida that I can sell and get you a really good deal on. Okay.
It's a very slippery slope. It's a very, very slippery slope. And remember, capital gains, I mean, talk about just the increase in capital gains rates. Capital gains right now, $80,000 is not taxed at all. So you have this huge exemption. And if you all of a sudden move it to, you just say, we're just going to make it ordinary income. All of a sudden that $80,000 that you made because you sold, you made a little bit in the stock market and you had $50,000, $60,000 of gain. All of a sudden now that's taxed at your 22, 25% rate.
Right. And I don't think on this show we have time to discuss what I'm going to mention, but it's just a heads up to everybody. There's also a lot of stuff going on at the state level. In Vermont, New York, and California, there are currently pending pieces of legislation. I'm not predicting they're going to be enacted anytime soon, although I always worry about Vermont because they're just a little crazy up there. But no offense to Ben and Jerry's, but well, they are crazy. But Vermont, New York, California, they all have pending wealth taxes, and they call them wealth taxes, but in many cases, they're taxes on unrealized gains. And some of the thresholds in those proposals, they aren't the 100 million, a billion. They're down like at 10 million. And so again, we've got our hands full just talking about what the Congress and the federal government's up to. But at the state level, there's also some pretty crazy ideas being thrown around with some degree of seriousness.
Let's turn to tariffs. And if we can, let's put it in context of what I've always thought, and I'd like your feedback on this. I've always thought was our biggest weakness, actually, from a tax standpoint in this country, is that we don't have a value-added tax. And that other countries, almost all other countries, have a value-added tax, which means that if we export to that country, it gets a value-added tax, which is a gross tax, not a net tax. But if they export to us, there's no tax. So France, for example, 22% value-added tax. Technically speaking, Airbus could send a 321 over to the US and no tax on that. But Boeing sends an airplane over to France and there's a 22% tax. And that's on gross amount. That's not on net amount. So in context of that, what's your feeling about the proposal for tariffs? If we can't do a value-add tax, our option is a tariff.
Right. You've raised a good question, and you've raised a separate issue, which is, or you didn't exactly raise it, but let me just say, by mentioning value-added taxes, you touched on a topic which I'd like to come back to. But let me talk about the tariffs first. The Trump campaign and President Trump in particular are talking most enthusiastically about are on Chinese goods. And their focus is not, it's in part this value-added tax issue, but what's really driving it is the feeling, which there's a lot of evidence to support is true, that the Chinese government subsidizes their manufacturing. They clearly pay lower wages. They clearly have circumstances under which laborers work that do not measure up to what the United States imposes on, appropriately, let me just say, on workplace safety. And the combination of all of that is that they can manufacture, just to pick cars as an example, that are considerably cheaper than U.S. manufactured cars of comparable quality. And what Trump's been saying, and he's saying it loudly in Michigan, because Michigan is one of the 7 battleground states that are going to determine the outcome of the presidency. He's saying if we don't do something about China's imports, it's going to put Detroit out of business. So a big part of what's driving the Trump insistence on tariffs is the fact that China has this incredible competitive advantage over U.S. companies. The tax differential is also important, but frankly, from listening to Trump and his people, I think it's this competitive imbalance that is a much bigger driver for them. Now, let me just jump back to the thing I alluded to, because it's such a great drift example. Value-added taxes were originally created in Europe after World War II. And when they were created, they were 1 or 2%.
Mhm.
And as you alluded to France, you said 22.5. All over Europe, you can look at history, and it only went in one direction. The rates all went up. And when they were originally enacted, and I say this because there's people in the United States who, particularly economists, who don't have any common sense. They will repeatedly say, we have a big deficit. The way to solve the deficit is we should enact a value-added tax. And they said the same thing in Europe. And what you will find is if you track the value-added taxes over 30, 40 years, the one thing they did was go up faster than the level of government spending. So no, government spending went up faster than the level of the taxes. So they never resulted in eliminating the deficits because spending always went faster than the value-added taxes went up, but they both went up. And so if you want another drift example, just go and look at the history of the value-added taxes in Europe, and it only went in one direction.
On top of that, you can never tax yourself to prosperity. That it doesn't work.
Well, no, it was a British prime minister, I believe it was Thatcher, who said the problem with the taxes on the wealthy and socialists is that they want to tax everybody, and pretty soon they run out of people to impose taxes on to pay for their programs. That I paraphrase, but that's the guts of what she said.
Ken, this has been terrific. Our job here is to give people a choice, let them know what the choices are. I think you brought out very clearly, not just the amount of the tax bill, the two different tax positions, but really where they go. So, for example, you have to realize that if Trump and the Republicans get in office, you do have to look at, do I want those clean energy incentives? Because they're going to go away. On the other hand, you're going to have these taxes that, even if they don't impact you directly immediately, at a minimum, they're going to impact your 401k. So at a bare minimum, because remember, your 401k is invested in those companies that now you just increased their tax rate by a third. By going from 21 to 28%. So just remember, that is actually a tax on your 401k. And so I think this has been so important. Ken, any final words, and then let us know where we can get more information about what you're doing.
The only final thing I would say is follow what both of the presidential campaigns are saying. They actually, both of them put out a lot of information on their positions, and you should be an informed voter. So take a close look at what they're saying and what the members of Congress who are running are saying, because it's going to impact all of us in a very serious way individually.
Absolutely. And where can we find out more about Federal Policy Group and other things that you're doing?
All you have to do is Google Federal Policy Group, and our website will pop right up.
Awesome. Thank you so much, Ken Kies. And thank you, everybody, for listening. We purposely delved a little deeper in this topic than we have in other videos and podcasts. And the reason is because this is such a huge swing. It's as much as a $7 trillion tax swing, $2 trillion on one side going down, $5 trillion on the other going up. And remember that, how we vote does make a difference when it comes to this, because as Ken, you pointed out very well, there are two likely scenarios, and we need to recognize that our vote impacts which of those scenarios is more likely or to actually occur. So, and when we learn things about policy, it's not just understanding policy, it's really understanding that this is how the tax law works. Ken mentioned, it's the staff of the Joint Committee on Taxation who actually writes the actual law. It's not your congressman or congresswoman that writes the law. They may suggest the law, they may vote on the law, but they don't write the actual law. And sometimes the IRS writes the law. And when we get better informed, we make more informed decisions, and we always end up with way more money and way less tax. Thanks, everyone.
Thanks, Tom.
You've been listening to the Wealth Ability Show with Tom Wheelwright. Way more money, way less taxes. To learn more, go to wealthability.com.